about what I should sell, and more focused on what I should continue to own, and letting winners run. The normal human behavior to fight against is it feels good psychologically to take profit. So, taking those profits feels great. We call that cutting the flowers and watering the weeds, to sell the winners and double down on these things that are cheap. We'll have a much better investment life and lifestyle. You might have a couple ideas your whole life and hold on to it for the whole time. And this town is a stark example of exactly that. I've been coming here since 1991, and the way in which Omaha has changed, how lovely this is, the degree of separation that any of that has from the success of Berkshire is sometimes less than we want. It's just all part of Berkshire stuff. And so many wonderful things happen in this town on account of it. So, I had one friend who was married, and he happened to be employed as an internal auditor for Berkshire. This is a long time ago. And he just bought a house, and then, furnishing the house and redoing the draperies and the couch and whatnot. And he actually sold a little bit of Berkshire stock to pay for this home furnishings. He said, that is the most expensive couch in history.
We're all one for investors. I think one of the key questions, you do a lot of homework up front. You hope that you can hold this out for a long time. I think one of the key challenges is if something's really changed. You look at the top 10 stocks in 1970, and they're different than 1980, with 90, and they'll be different 10 years from now. The question is what has changed? I mean, GE, Jack Welch was one of the largest stocks. Enron was the second largest stock. I know Enron, a lot of people in Omaha lost a lot of money because they bought a pipe company that was based here, ran up and went to zero. So what's changed on the management is key, or did the company completely change itself? Because I think that's one of the real questions you have to ask yourself. Was it regulatory? Was it, the founder goes, will Berkshire be the same without Warren Buffett or Charlie Munger? Question mark. It should be. It should last a very long time. But if you lose a key, you shouldn't be one person. When you're the largest company in the United States, you shouldn't be that difference. But sometimes, TV companies, Sylvania was a top 10 company in the 70s. So what's changing, and do you keep up with it? It's pretty. Look at AOL, was one of the biggest companies, 99. So.
I think, in general, so I think a lot of your outperformance is paying attention to, let your winners run and strong believer in that, and cut your losses, right? Being able to say you got something wrong and walk away. Don't keep working at it to try and make it right. I am hopefully the first one to admit, it's my investment, I know what I bought it for, it changed, the story changed, it's not what I thought was gonna happen. I don't wait around to refabricate the story to fit what's actually happening. I just say, okay, I need to get this one right and move on. But I've got these other stocks over here that are doing really well. So go back and focus on, what you got that's working, and recognize when you got something that isn't working. Be able to walk away from it, save yourself some pain, and also save yourself some capital, because you'll be able to, in my experience, I've been able to, extract myself from those situations sooner rather than later, so I have more to deploy elsewhere.
And I would say that, the first thing is to make sure you've got a idea of what you think valuation, we have an idea of what we think accountants are worth, and use that to guide our purchase and sale decision. But the other thing is, there's two different aspects. One is if you're searching for the proverbial cigar butt with a couple of puffs left on it, you better be darn sure what you're paying for it, what it's worth, and when it gets to what it's worth, just get out. But if you are buying these compounders, these companies that are the PepsiCos and things like that you've been on for a long time, if the intrinsic value of the company is rising and it's not a stagnant business that you're just hoping to get up to some value and get out of, that's what we like to focus on. So those businesses where the intrinsic value is rising and you can compound that over time, that contributes to those decisions like Tom said, where you can not sell the company and just continue to own it.
Hello, my name is Tom Wynn. I'm a student of the game, and going back to your story, Mark, the book you read about the NBA, I want to bring in an NBA analogy into value investments. I fundamentally believe in value investment, the philosophy. But if you look at the NBA about 40, 50 years ago, they introduced the three-pointer line. And it wasn't until 30 years later we had people exploiting the three-point line. We also have centers shooting the three-point line. So now that we're value investors and we have to learn to adapt, how can we be more like Lamar Jackson, being a quarterback that knows how to rush and how do we think about momentum investing, and how do we use different skills to make ourselves better investors than, the old fundamentals of net, and then just buying high quality, and then you define high quality by monopolies, duopolies, patents. What are those next stages for you about the written and unwritten rules in the game of investing currently?
I brought the NBA, so I'll start with that one. Again, I guess what I would say is, there's shades of value investing, and we always articulate this with our clients, is that we're not what we would characterize as deep value investors. We're not just looking around for just quantitatively cheap stocks. That sometimes leads you to stagnant businesses or declining businesses, again, that you're hoping to get that one-time surge to some value and get out of. We go back to the idea of we're trying to find good businesses, and I think that's kind of the evergreen part of it. That if you find a good business and it has those characteristics that are allowing it to grow its intrinsic value over time, that is a type of investing that we think is sustainable, even though there are constant changes in learning how to bring these differences of technology and decision-making and rapid-fire markets to bear. But again, for us, it all comes back to own a good business, make sure you don't overpay for it, and things tend to work out well in the long run when you do that.
Spush.
Coming from Chicago and watching 6 championships, I think understanding how the rules have changed, and looking at today's game, you can ask yourself, do we even play by the rules, because it's not the basketball that I was taught. So, a touch foul, that's today's game, right? And then looking at probabilities, right? So if you have a probability or, something like Seth Curry who can light it up, but he also can't be touched, like Jordan would get pummeled. So understanding how the rules have changed, you could say that the Fed provided, free capital over the last decade, changed the rules of the game. So understanding that it can change back. Also understanding that there are certain people who are treated a little differently, whether it was Shaq or Michael or Pippen or LeBron. Is he playing the same game that the other 9 guys are on the court? Because that matters. And I think that's one of the challenges, because there's a lot of nuance that's going on in the game, but more importantly, there's the second part of the game, which is defense, right? So protecting capital, usually good defenses win. So making sure you understand it's not all about the guy who scores 40, it's about the guy who prevents the other guy from scoring 40. And that's why the Bulls won. Michael Jordan didn't win by himself. When he retired to play baseball for 2 years, Scottie Pippen didn't do too much. And neither one of them could have won without Horace Grant, Steve Kerr, and a variety of the other niche players, which were the total differentiation. So it's still a team sport, but the question is what are you doing on the other side? Protect capital and to take advantage of the ever-changing landscape, be it inflation, be it free money, the tight space, globalization, regulation. If feds come in and start regulating Twitter, Amazon on the data, they're beginning to, Apple, all you gotta do is look at anyone, who's using advertising off of their apps. Apple changing the privacy default to, no, is a game changer. It's hitting Facebook, it's hitting everybody else on that. So understanding that is tweaking the rules a little bit, and you gotta really understand that because it can blow you up pretty quickly. So I think there's a great question, and there's a lot of nuances, that are changing today, because it's still investing, but the rules are a little different today, and there's a lot of different factors in planning.
Okay, well, thank you, Tom, Doug, Susan, Mark. Thank you so much for your time today. Annie, would you like to come up and close us out?